In today's video, I'll be revealing the simple tax strategy that most retirees never learn, which can save tens, possibly hundreds of thousands of dollars throughout your retirement. If you're new to the channel, hi, I'm Julia Lemke, certified financial planner, and through analyzing retirement tax situations and working with clients who've implemented this approach, I've discovered how one strategic decision about account withdrawal order can dramatically reduce lifetime tax burdens. And that's exactly why I'm making this video today, to show you the specific withdrawal sequence that minimizes retirement taxes, why most retirees get this backwards, and how to implement this strategy to keep more of your hard-earned money. I encourage you to watch through to the end because I'm going to give you tax tips that all of you can use without having access to sophisticated software that will help you determine the best withdrawal strategy for you. And even though I love Roth conversions, these tips don't require them, so let's get into it. Many new retirees are shocked to discover that their tax burden doesn't decrease, it just changes form. In fact, retirement taxes often catch people completely off guard because while you're working, the rules shift dramatically to when you're retired. While most workers are accustomed to predictable tax withholdings from wages and salaries, retirement income comes from a patchwork of sources: Social Security, IRAs, Roth accounts, pensions, annuities, and brokerage accounts, and each one is taxed differently. As a result, many retirees are blindsided by how quickly their tax liability can grow, especially when distributions bump them into higher tax brackets or trigger hidden tax penalties. One of the most misunderstood elements is how taxes in retirement can be stealthy, creeping in through less obvious channels. For example, retirees often face the Social Security tax torpedo, where up to 85% of their benefits become taxable based on provisional income thresholds. And there's also the Medicare IRMAA surcharge. Higher income retirees pay, where they pay significantly more for Medicare Parts B and D, and these income thresholds are surprisingly low and they're based on prior year's income. Then there's the net investment income tax, which is a 3.8% surtax that kicks in for retirees with moderate investment income. And there's also the AMT, or alternative minimum tax, which can apply unexpectedly, especially if tax strategies like large deductions or certain types of income are not carefully managed. A key reason this tax complexity costs retirees thousands in unnecessary payments is that the tax treatment of retirement assets varies so widely. For example, if you take too much from tax-deferred accounts early on, you can inflate your taxable income and drive up Medicare premiums or cause more of your Social Security benefit to be taxed. Meanwhile, failing to take advantage of those lower income years early in retirement to convert or even to, withdraw from pre-tax accounts can lead to much higher taxes later in retirement, resulting in higher total lifetime taxes. Ultimately, most retirees have never had to actively manage their tax brackets before. And without a personalized withdrawal strategy that coordinates account tax types, tax brackets, and key thresholds, retirees often end up paying far more than necessary. Understanding how retirement income is taxed and where the hidden taxes lie is critical to preserving wealth and avoiding costly surprises. The biggest mistake retirees make with their withdrawal strategy is following a default one-size-fits-all approach, often using conventional wisdom, which is pulling from brokerage accounts first, then tax-deferred accounts like IRAs and 401ks, and finally Roth accounts. This approach is overly simplistic and in practice can be extremely costly. By spending down taxable accounts early and delaying withdrawals from tax-deferred assets, retirees unintentionally allow those tax-deferred balances, or what I call tax bombs, to balloon. This leads to much larger required minimum distributions later, which often force withdrawals at the worst possible time, when retirees are in higher tax brackets, facing increased Medicare premiums, and triggering the dreaded Social Security tax torpedo. This withdrawal sequence also misses the opportunity for proactive tax planning. In the early years of retirement, before RMDs kick in and Social Security is fully taxed, many retirees are in unusually low tax brackets. These are the golden years for strategic Roth conversions and capital gains harvesting. But if brokerage accounts are drained first and tax-deferred assets are left untouched, retirees forfeit that window. By the time their RMDs begin, their options are limited, and the compounding tax consequences are already locked in. Meet Jim and Carol, both 65 with a comfortable nest egg. $500,000 in a joint brokerage account, $1.2 million in traditional IRAs, and $200,000 in Roth IRAs. They need about $100,000 a year to maintain their lifestyle, and they plan to delay Social Security until age 70 to maximize their benefits. Now, I don't ever recommend that both spouses wait till 70, but just stick with me with this for this example's purpose. Like many retirees, they follow conventional wisdom and begin drawing solely from their brokerage account to fund retirement, assuming that this is the most tax-efficient strategy. In the short term, it does feel smart, right? Capital gains and dividends from their brokerage account are taxed at low rates, and they owe little to no taxes during these early years. But this seemingly simple approach actually sets them up for long-term tax problems. By relying entirely on their brokerage account between ages 65 and 70, they allow their tax-deferred IRAs to grow untouched. By age 73, thanks to compounding, these IRA balances have grown to $1.6 million, triggering large required minimum distributions of over $65,000 a year. And at the same time, they begin claiming Social Security, receiving a combined $90,000 annually. So now that their income has ballooned, they're pushed into higher tax brackets, and they also have to pay Medicare IRMA, and 85% of their Social Security benefits are taxable. And really, they have no choice, right? They're spending a certain amount of money, right? Let's say they're spending, at this point with inflation, and let's say they have some home repairs and they want to do some gifting. Let's say they're spending $200,000. Well, now they don't have a choice with where they pull out that money, right? It has to come out of that pre-tax IRA account, which means they're going to be pushed over the IRMA limit and into a higher tax bracket. At this point, they have no other resolution for being in a high tax bracket for the rest of their life. Because Jim and Carol didn't take advantage of the low tax window in their early retirement years, they missed a powerful opportunity to reduce future tax burdens. Had they withdrawn even modest amounts from their IRAs or completed Roth conversions between ages 65 and 70, strategically filling up the 12 or 22% tax bracket, they could have lowered future taxes by a lot. Even converting $50,000 per year to their Roth accounts over 5 years could have saved them more than $100,000 in taxes alone over the course of their retirement. Unfortunately, optimizing your withdrawal strategy is no easy feat, and there is no one-size-fits-all. This planning requires sophisticated software and experience, but there are some tips and tricks that everyone can follow to determine which sequence of returns might work best for them. Tip number 1 is that if you're retiring at age 65 or older, meaning that you're already eligible for Medicare, and you have large pre-tax accounts and you don't want to do Roth conversions, you'll definitely want to take a portion of your needed income from these pre-tax accounts while you're in a much lower tax bracket before Social Security benefits start and or required minimum distributions are due. So for instance, let's say you're a 65-year-old couple and you have a traditional IRA with $2 million, $300,000 in Roth IRAs, and $200,000 in cash. You're used to being in the 24% tax bracket, and now you need $120,000 a year to live comfortably. One spouse is pulling their Social Security benefit at $20,000 per year. You have qualified dividends of $15,000 per year and taxable interest on your savings of $8,000. You pull the remainder of income needed from your cash, and we can see here that you'd be in the 10% tax bracket owing zero or nothing in tax. So you're not taking advantage of your lower tax bracket, you're just pushing your tax liability into the future at unknown tax rates. Now let's see what happens when you take a portion of your needed income, say $30,000, from your pre-tax IRA. So same Social Security dividends and interest, but now a $30,000 IRA withdrawal. We can see here that you're still in the 10% tax bracket and you're able to pull IRA funds out and be in a 7.3% tax bracket, right? Pay 7.3%, 2180 divided by 30,000. And this is one way to pay a nominal amount in tax and realize some tax liability before you have no choice at full Social Security age and RMD age. Even better, you could take the $30,000 from your pre-tax account and trim a concentrated position in your brokerage account for a $30,000 long-term capital gain and not owe a penny because you'd fall in the 0% long-term capital gains brackets. Speaking of trimming concentrated stock positions, let's move on to tip number 2. which is to trim or donate concentrated stock positions during your first few years of retirement. In the last example, this couple realized a $30,000 long-term capital gain at a 0% tax rate. In this scenario, they can actually trim a stock position for income at up to $55,000 in long-term capital gains while still paying zero in taxes. This means they can keep more of their cash position without paying any extra in tax. Next, if you give to charity every year and you're used to just giving cash, listen closely. If you have a brokerage account with highly appreciated stock, especially a concentrated position, you're in a unique position to give smarter. Let's say Linda owns $100,000 worth of stock in a single company, which she bought years ago for just $10,000. If she sold that stock today, she'd owe long-term capital gains tax on $90,000 of the gain. At a 15% capital gains tax rate, not including state taxes, that's a tax bill of $13,500. But if Linda donates those shares directly to a qualified 501c3 charity, she completely avoids paying capital gains tax and the charity receives the full $100,000 value. On top of that, she gets a charitable deduction for the fair market value of the stock, assuming she itemizes deductions. That could save her even more on income taxes, depending on her tax bracket. This strategy is especially powerful for retirees who don't need all of their brokerage assets for income and want to reduce portfolio risk or rebalance out of legacy stock positions. It allows you to fulfill philanthropic goals while avoiding a large, unnecessary tax bill, and often does more good for both your finances and your favorite causes than just writing a check. Another great tip for giving if you're at least 70 and a half years old is to take advantage of the Qualified Charitable Distribution, or the QCD. This tax law allows you to donate up to $108,000 in 2025 to any and all 501c3 organizations directly from your pre-tax IRA. This is the smartest way to give, and you're bypassing ordinary income tax on those monies and lowering future RMDs. You can also open a donor-advised fund, but that's a topic for a different video. Finally, tip number 3, or really tip number 4 or 5, is to not hesitate to pull from your Roth account if you're at risk for a Medicare IRMA surcharge or jumping a bracket. You've probably all read that your Roth money, you shouldn't touch that until last because you're wanting to allow those tax-free monies to grow for as long as possible. However, if you find yourself on the brink of a Medicare IRMA charge and you need more income, instead of following whatever distribution plan you think you should, you're going to want to pull that remainder of the needed income from that Roth IRA. Recently, new clients in their late 60s showed me their 2023 tax return with their married filing jointly status and adjusted gross income of $213,000. Unfortunately, none of that $213,000 was eligible to appeal, so this pushed them into the second Medicare IRMA tier. So instead of paying $185 for Medicare Parts B and a $0 Part D penalty, they were forced to pay $259 for Medicare Part B plus a $13.70 Part D penalty each, increasing their health insurance bill by over $2,100 for the year, all because of a bad withdrawal strategy. You see, they had $200,000 in Roth monies between them, so they could have pulled that last bit of income from one of those and just avoided that IRMA penalty altogether. So this is a lesson for everybody watching. Don't just leave those Roth accounts for last. Be really strategic with them if you're at risk in the same scenario. Okay, before I move on, these 3 tips will save you thousands annually in retirement. Click the link in the description to watch my free training video where I'll show you exactly how to implement this tax savings approach to your specific situation. Now, you may have noticed that these tips apply to folks that have some tax diversification, meaning that they don't have nearly all of their wealth in pre-tax accounts, right? They have a mix of brokerage, pre-tax, and a little Roth. And this is absolutely crucial and the foundation of smart retirement tax planning. Having these different tax buckets gives you control over when and how much you pay in taxes. It allows you to adjust your income strategy each year based on your tax bracket, your Medicare thresholds, and your Social Security taxation. So instead of just blindly following traditional retirement advice and maxing out that pre-tax 401k, you should be following a more nuanced savings plan. Here's a blueprint to follow if you're still in the savings phase. First, be sure to max out your 401k up to the match. I shouldn't have said max out. Contribute to your 401k up to the match. If you can do a Roth 401k or 403b or 457, max it as much as you can. Remember, folks, Roth 401ks, 403bs, and 457 contributions are not subject to the earnings exclusion, which means that you can make as much money as you want and still be eligible to contribute. These income exclusions are only on Roth IRA contributions. Confusing, I know. Second, if you're on a high deductible health plan, max out a health savings account to take advantage of tax-free contributions, growth, and withdrawals for qualified medical expenses. Next, if you don't have access to a Roth employer plan, max out a Roth IRA either by direct contributions or backdoor contributions per the rules. And finally, if you have money left over, contribute to an after-tax brokerage account. This way, you're prioritizing tax-free growth, which is going to save you thousands of dollars upon retirement. So now that you have the blueprint, now that you have these little tax tips, you can start to apply these directly to your own situation. And if you're within 5 years of retirement and want a real bulletproof plan, click the first link in the description below to watch our free training video on how we help clients achieve the retirement of their dreams. I'll see you next time.